All right, welcome to this episode of Market Shares. My name is Tony Blodgett, and I'm here today to talk to you about the Federal Reserve. They're making moves. We knew they were going to. We knew this was coming. But what does it actually mean to you? Let's take a couple minutes and unpack all of what happened yesterday with the Federal Reserve announcement. So first of all, I think the most important thing to understand, you guys, if you haven't seen it, if you haven't heard about it, we have a lot of inflation going on. And the only tool, really, the number one, but really almost the only tool that we have to fight inflation is the Federal Reserve can raise short-term interest rates to help bring down inflation. So why does that work? I get asked this question all the time. Why does that actually lower inflation? Well, it's really easy. Here's what happens. When the Federal Reserve raises short-term rates, it makes the cost of borrowing money more expensive. Now, not necessarily mortgage rates. I'm going to touch on that in just a second, but it does increase the prime rate. It increases your credit cards, car loans, home equity lines of credit, and other short-term financing. So when consumers have less access, less purchasing power because they're less likely to borrow the money to buy more goods, that lowers the demand for these goods. And so by lowering the demand, it will help bring down the price. And by bringing down that price, you guys, that's what's going to bring down inflation. Now, what drove it up in the first place? Well, we had an abundance of liquidity. We had really low interest rates, and we had supply chain issues that were making the goods that we wanted to purchase not available. There was a lot of scarcity there. So we have to reverse that we have to get less consumers to purchase things. Now, here's the challenge with that, is it can potentially put us into a recession by slowing down the economy too much. The Fed has to be very careful here. But here's the other thing that we're looking at is that right now, mortgage-backed securities have gone up pretty quickly. They've gone up because of inflation being so high. But contrary to popular belief, what happens is when the Fed starts taking aggressive action to fight inflation, the investors of long-term mortgage-backed securities actually like that because it preserves the value of their long-term investment. And so what can happen is mortgage rates can actually drift back down. And the initial reaction we had after the Fed statement yesterday was rates spiked up, but then they did calm down and they started coming back down, and mortgage rates were actually a little bit better today now that the bond traders know that inflation, that fight against inflation is on. But what that can do is if 30-year rates come down and the Feds keep raising short-term rates, that spread between the two is called the yield curve. And when that yield curve inverts, meaning when short-term rates are higher than long-term rates, the last 8 times that has happened, it has put us into a recession. So you look at the fact that we have a very flat yield curve, almost inverted. The Fed has already told us they're going to continue to raise interest rates 6 or 7 more times over the next year and possibly 4 more times in the following year. And we have this war overseas. All of these things can be very indicative of a potential recession. Now, what happens typically during a recession? Well, the good news is housing typically does very well and interest rates come back down. So you guys, that's what you can expect with what the Fed's doing. The other thing that they really changed, and I got a really interesting printout here, which if you'd like a copy of this, I'll be happy to share it with you. Essentially, it takes the words that they said last month and the words they said this month, and it shows you exactly what changed. And one of the big parts that the Fed did change is their language about how they were going to unwind the balance sheet. So what that means is the Fed's been purchasing mortgage-backed securities and U.S. Treasuries since the pandemic started in large quantities. That's called quantitative easing. And they've stopped doing that, but they're also going to start selling the assets they have. When they do that, that's going to create an oversupply, potentially, if they do it too quickly, an oversupply of mortgage bonds on the market. And when there's an oversupply, like anything, the price is going to go down. And when the price goes down, the yield goes up and interest rates could go up. So we have a lot of things happening here. And I don't want to predict exactly what's going to happen. I personally think interest rates are going to probably go back down at some point, maybe later next year. But this is really going to unfold month by month. So pay attention here to market shares, because over the next months, I will be going over the Fed's exact words, what they're doing, why they're doing it, what the impact is on you, and how it's going to affect mortgage interest rates. But for now, guys, Thanks for watching this episode of Market Shares. I'm Tony Blodgett, and I'll see you on the next show.